Okay, the latest consumer price index report came in hot. Headline CPI surged 7.9% in February. As many sectors grapple with higher costs for labor and energy. Joining us now for more on this inflationary backdrop is Bank of America global economist Aditya Bave. Good morning to you here. Let me get your take on this report. And then secondarily, Aditya, what do you expect for the March CPI?
Good morning. So another very strong CPI report, 0.5% on core, 0.8% on headline. And then in year-over-year terms, the core is running at 6.4%, which is the strongest, of course, since 1982. Now, in terms of where the strength came from, really across the board, which is quite striking. I would chalk it down to three drivers. So first of all, there's supply disruptions. There you can look at the strength in apparel, in household furnishings and supplies, pointing to just continued pressure on supply chains. Then you can look at the strength in demand, which is both cyclical, as evidenced by rental inflation, again very strong, as well as reopening driven. So you can look at lodging, transportation services. So that's another impetus for the economy, that it's not just supply issues, but demand is actually very strong. And then, of course, if you look at the non-core components, energy and food, we're starting to see the impact of the Russia-Ukraine conflict. Now, on your question of what happens in March, I think continued strength, because all of the factors I just cited are not going away. And then, of course, the most concerning one is the conflict. So we'll have to see what happens with food prices, energy prices. But from what we know in the first several days of this month, clearly there's going to be more upward pressure. I mean, gas prices, wheat, corn, all exploding, fertilizer as well.
Well, and Aditya, on that last point, I mean, if you look at the effect of the Russian invasion of Ukraine, you didn't really, I mean, yes, you already had strength in energy prices and grains, but they didn't really take off until the beginning of March. And so that implies two things to me. One, as you say, we could have quite a number in March. But secondarily, if the numbers that we saw in February were this strong, even without the full force of that effect, that suggests that underlying inflation is still really high, doesn't it?
Absolutely. I mean, it's certainly a concern. You're going to see more divergence between headline and core inflation. And while the Fed continues to focus on core inflation as its key target, core PCE actually, not core CPI, but they're related, I think they're going to have to pay attention to what's happening with non-core prices as well, because, of course, these are the items that are consumed disproportionately by lower income households. And they're also very visible prices, because we spend on food and energy much more frequently than, say, we spend on rent. So for all of these reasons, I think the Fed is not going to strictly talk about core prices, but they're going to have to address the issues with non-core prices. And I think that keeps them on a very steady hiking path. We continue to forecast 7 hikes this year, 25 basis points each.
There's still a lot of hesitancy, Aditya, on the street about calling a potential recession in the U.S. Now, let's look at it another way. A recession technically is 2 quarters of back-to-back negative growth. Do you expect at least 1 quarter of negative growth this year because of what we are seeing on inflation?
No, I don't see that this year. Household balance sheets are very strong. And there's some evidence that even if you focus on lower income households who have a higher marginal propensity to spend, their balance sheets are pretty solid. The other point that's worth making is that there are still pockets of the economy that could benefit quite significantly from reopening driven demand. So as long as we don't get another large COVID wave, I think there's room for some, relatively easy growth over the spring and summer that should help the economy stay quite far away from recession, in my view. I mean, if you want to think about recession risks, then I think the second half of 2023 going into 2024 is where we become much more concerned, although I will highlight that that's not yet our baseline forecast.
I want to turn it to Europe for just a moment, because first of all, we're seeing obviously the effects of inflation there as well, perhaps in some areas even more acutely. Natural gas, for example, as we were discussing with previous guests. Here's a look at some sampling of international inflation. And of course, today the ECB said it was going to be shrinking its balance sheet gradually and not until May. But nonetheless, did that surprise you? And do you think the ECB is making the right decision here in getting maybe a shade more hawkish?
I think it's a very difficult balancing act for central banks outside the US for a couple of reasons. The first is that, the commodities we talked about, wheat, corn, energy, these prices are quoted in dollars, and the dollar is rallying in the global risk-off trade. So the non-dollar prices, euro or EM currency prices of these commodities are actually increasing even faster. So they're facing a more acute inflation problem. But on the other hand, I think the downside risk to growth for these countries is more as well. So there's a distinction between countries like the US that are facing a price shock. And because of that price shock, there's some impact on real spending power. People will have to cut either their consumption of food and energy or something else, most likely. But then there's countries like Europe, which is very dependent on Russia for gas. It gets a quarter of its crude oil and a third of its gas from Russia, natural gas. And then in the Middle East and Africa, those countries get a lot of their food supplies like wheat and corn from Russia and Ukraine. Those countries are facing actual cuts to quantities available of these essentials, food and energy. And that's a much more concerning situation for the economy and obviously for just welfare of the people, right? So it's a tougher balancing act for those countries than for the US, which is in a relatively less uncomfortable position right now.
So then for that reason, Aditya, do you see that there is risk of recession elsewhere around the globe, even if not in the US, and not just recession, but potential stagflation elsewhere around the globe?
Yes, I think certainly the risks are higher in other countries. We've cut our global growth forecast for this year from 4.3% to 3.6%. That's a pretty big cut for global growth, especially when our US cut is relatively small and we've not cut China at all. So the rest of the world is going to see a much bigger impact in our view. And again, like you said, both recession and stagflation are risks. It's not our base case for Europe yet, but we've made pretty big cuts to the euro area. Emerging EMEA, of course, will be hit the hardest. Russia, we expect a pretty big recession this year. So the countries in that region are obviously the most exposed to this crisis.
Aditya, let's go back to the U.S. here. What is the impact to the financials, that household balance sheet of, let's say, a couple earning $100,000 a year in an inflationary environment that we are seeing perhaps this month? That consumer price index might be 10%. What is the impact to lower income America here?
Right. So lower income households are the most impacted by inflation, in part because they save a smaller chunk of their income, and in part because they spend more on particularly the items that are seeing the most inflation. For example, food, energy, cars, and household furnishings and supplies. But that being said, the good news is that lower income households are also seeing the fastest job growth and above average wage growth. So there are some households that didn't have jobs at all that are now, or consumers that didn't have jobs at all that are now getting jobs. And then those that already had jobs are seeing above average wage growth. And if you look at some data from the Fed on household balance sheets, you can see that there's been increases in net worth across the wealth distribution, including to lower income households. So those are all encouraging factors in our view, which will help the economy avoid a recession, even though certainly what's going on right now is a concern for lower income households.